This is Carl Dahm with the Real P&L channel. Welcome to lesson number 5 of my 8-part video series, Stocks versus Options. Just a quick reminder from a part of lesson number 1. If I had most of my net worth tied up in a blue chip stock portfolio, I would not sleep well at night because that portfolio is too risky. I have been studying passive income for over 30 years, and a modern options portfolio is the most conservative passive income vehicle I have found. A modern options portfolio not only reduces risk, but also provides higher returns when compared to the market. A modern options portfolio is made up of options positions that follow the 12 principles outlined in my new book called A Portfolio for All Markets. Now let's get into the differences between stocks and options. There are 8 key differences. 2 of those differences actually favor stocks, and 6 of those differences favor the modern options portfolio. Next, I will go over options advantage number 3. What happens to assets over time? Well, some appreciate over time and some depreciate over time. Picture yourself as an owner of a car lot where you sell cars. The cars that you sell are depreciating assets. Picture yourself selling a brand new car to someone, and then time goes by, maybe a couple of years, and you buy that car back. Well, that car has depreciated over time, and you actually buy it back for a lot less than what you sold it for. Options premium can be sold, and when it depreciates over time, you can buy it back and make a profit. Typically, the more time that passes, the more profit you can make on the option that you've sold. Time is on your side. A stock portfolio has no time advantage like options. An example would be the last decade from the year 2000 to the year 2009, when stocks did not go up or appreciate in that whole 10-year period. Let me give you another example of how time can work in your favor. For example, insurance companies. If you have a vehicle, you're more than likely paying insurance on your car every month. Let's say you pay $100 a month. So at the end of the year, you pay $1,200. Well, statistically, the insurance company will run the numbers and they will calculate out that more than likely they're not going to spend more than $1,200 fixing your particular vehicle. So they have a statistical advantage as time goes by that they're going to actually come out ahead and make money. So the basic premise is to put time in your favor by selling option premium, waiting for time to go by, let the option depreciate, and then buy it back for less than what you sold it for. Now to recap the modern options portfolio versus a stock portfolio. The first difference we talked about was liquidity, and stocks have the edge when it comes to liquidity. The second difference we talked about was trade execution. And I went a little bit into if you execute your trades properly with options, there is no advantage to stocks or options when it comes to trade execution. Third, I talked about direction. And with a modern options portfolio, because we don't have to pick a direction, that's a major advantage for the options portfolio. Fourth, I talked about diversification, and I went over how an options portfolio actually is more diversified through the different market types. So the options portfolio gets the check mark on diversification. And fifth, I just went over time, how to keep time on your side by selling depreciating assets and purchasing them back for a profit. If you feel that you've learned anything from this lesson, please subscribe, click the like button, and the notification bell. This will promote the video on YouTube and provide opportunity for others to see it. If you're interested in watching a modern options portfolio with live P&L on a daily basis, just subscribe to my YouTube channel, Real P&L. Stay tuned to Real P&L for lesson number 6 of my 8-part series, Stocks versus Options. In lesson number 6, I will go over how there is an edge for options traders and how to take advantage of that particular edge.